Imagine working hard for 10 years. You saved carefully, skipped vacations, drove the exact same car. After a decade of discipline, you look at your savings account and see $50,000 sitting there safely. Now, imagine someone, you never met them, never agreed to a contract with them, quietly creates another $1 trillion and slips it into the economy while you sleep. Your account still says $50,000, but the value of what that number can buy dropped. Nobody stole from you, and the market didn't crash. This chart shows the U.S. money supply over time. Between January 2020 and January 2022, a span of just 24 months, you can see a massive vertical spike where the Federal Reserve expanded the money supply by roughly 40%. Nearly half of all U.S. dollars that existed at the start of 2020 were created in the following 2 years. If a company printed 40% more shares of its stock, existing shareholders get diluted. The overall pie stays the exact same size, but suddenly it has twice as many slices. We're talking about the money in your wallet, your savings, and your paycheck. That mechanism is designed, documented, and legally authorized. Economists debate it, governments depend on it, and banks profit from it. The inflation that followed was a mathematical consequence of expanding the money supply. Grocery bills, rent, and car payments climbed because more dollars were chasing the same goods. The purchasing power lost during those years does not come back. The cost of living for everyday people shifts permanently. Ask most people where money comes from, and they assume the government prints it. But the vast majority of currency in circulation, estimates put it above 90%, is never physical. It exists purely as digital data. It comes into existence the exact moment someone takes out a loan. When a borrower walks into a bank and gets approved for a $300,000 mortgage, the bank does not pull that cash from a vault. It does not transfer funds from another depositor. The bank creates that money right there in the transaction. It types a new number into a ledger. $300,000 that did not exist before the loan now exist. Consumer debt acts as the engine generating new money. There are limits to this engine. Institutions like the Federal Reserve control the interest rate at which banks borrow. When they cut rates, borrowing becomes cheaper. More loans are made, and more money enters the system. Raising rates has the exact opposite effect. Central banks also use a much larger mechanism called quantitative easing, or QE. They buy government bonds and other financial assets by generating new money from nothing, injecting liquidity directly into the financial system. They do not tax to get this money, and they do not borrow it. The scale of this intervention has grown massively over the last 2 decades. Before the 2008 financial crisis, the Fed's balance sheet, the measure of money it created and injected, sat under $1 trillion. By 2022, the authority overseeing this system watched that balance sheet balloon to nearly $9 trillion. Every single time new money enters the economy, whether through a local mortgage or quantitative easing, the total supply increases. When supply grows faster than the actual goods and services available, each individual dollar loses a fraction of its value. When the government issues bonds and the central bank buys them with new money, that capital enters the economy at full face value. The people and institutions receiving it first get to spend it before general prices have had a chance to rise. This diagram illustrates a principle known as the Cantillon Effect. It shows that money is not neutral. It originates at a central point and begins rippling outwards. The entities closest to the source, governments, banks, and major asset holders, benefit the most because they spend the money at yesterday's prices. Those at the center see their asset prices rise and their borrowing costs stay low. But by the time that new money reaches the people furthest away, the savers, the pensioners, and the everyday wage earners, prices across the entire economy have adjusted upward. The people at the edges absorb the loss. Economists call the profit derived from this specific chronological advantage seigniorage. In modern economies, it functions as a built-in benefit flowing directly to the institutions that possess the power to create and spend new money first. The cost of this structural disparity distributes silently across everyone else who holds the currency. It operates as a hidden tax on prudence, transferring wealth away from cautious savers and toward those holding major assets. The Federal Reserve officially targets 2% annual inflation. While that sounds harmless, the math tells a different story. At a consistent 2%, the purchasing power of a dollar drops by half over 36 years. That is an entire career. But inflation does not always hold at 2%. During the spike in 2022, U.S. inflation hit over 9%. At that rate, a dollar loses half its purchasing power in just 8 years. For most workers, wage growth consistently lags behind these spikes. Even as nominal paychecks creep up, the actual purchasing power of those wages stalls or falls. The cost of living and the price to acquire assets pull further away from an average income. Housing reveals exactly how this plays out over decades. In 1970, the median home price in the U.S. was roughly $17,000. Adjusted strictly for official inflation metrics, that home should cost around $130,000 today. Instead, the modern price is closer to $400,000. That gap, the distance between what inflation-adjusted prices should be and what working-class wages can actually buy, shows exactly who the system protects. It is the direct, measurable proof of purchasing power transferring away from everyday buyers and moving toward asset holders. This system does have a function. The ability to create money rapidly funded direct payments during the 2020 lockdowns, supported public infrastructure, and arguably stopped the 2008 financial crisis from spiraling into a total collapse. It solves immediate, catastrophic problems. But relying on this mechanism creates a long-term trap. Debt loads grow so large that central banks must keep interest rates artificially low just to manage those obligations without defaulting. Japan has run this experiment longer than anyone, managing mountains of government debt through near-zero rates for decades. Citizens trying to defend themselves often flee cash entirely. They move their savings into real estate, commodities, or alternative assets that governments cannot print. But executing that defense requires capital, high risk tolerance, and a level of financial literacy that leaves millions exposed. The benefits of the system, the stimulus checks, the infrastructure bills, the emergency bailouts, are highly visible, named, and politically celebrated. The resulting costs are entirely invisible, unnamed, and easily denied by the officials passing the policies. If a government sent you a bill each year for the exact amount of purchasing power lost to monetary inflation, people would demand justification. There would be immediate political consequences. But because the system diffuses the cost silently across the entire population, the wealth is collected without accountability, and most importantly, without anyone ever asking for your consent.